Hello folks, this is Vincent Virga, President of PFS Wealth Management Group, with our educational economic update for April 2017. In this month's video, we're going to discuss some of the major headlines that influenced the stock markets in March and provide insight into what these developments could mean for you as an investor. But please make sure to stay tuned at the end of this video for our required disclosure statement. Well, with April in full swing, the first quarter of 2017 is now in the books. We won't have quarterly economic data for a little while, but we do know that all three major indexes gained at least 4.5% in the first quarter. The NASDAQ even experienced its best quarter since 2013. But most of these gains occurred in January as well as February, as the NASDAQ was the only one in these three indexes to actually increase in the month of March. After numerous record highs in February, March saw the S&P 500 flatten and the Dow give back about 72 basis points or 0.72%. While the markets may have provided fewer record-setting headlines in March, we do pass a milestone in the economic recovery, the 8th anniversary of the Great Recession's lowest market day. Looking at a few data points can show just how far the economy has rebounded since 2009. Let's first consider unemployment. Gosh, in March 2009, the unemployment rate was 8.7%. As a matter of fact, it reached 10% by October of that year. The most recent readings, though, for 2007 were 4.7%, less than half of the highest rate during the recession. Next, the GDP also improved during the same time. In March 2009, we learned that the economy had contracted by 6.3% in the fourth quarter of 2008. It's the worst decline in 26 years. Last month, we received the final fourth quarter 2016 GDP readings, which reported an increase of 2.1% from the previously calculated 1.9% growth rate. While the recovery pace has been slower than many people would prefer, the economy has grown almost every quarter since 2009. Another sign of our continuing economic recovery is the Federal Reserve's tightening fiscal policy. The Fed raises interest rates in an attempt to keep the economy growing at a reasonable pace, as well as to control inflation. For a decade, between 2006 all the way to 2016, the Fed did not raise interest rates a single time and took the rate from 5.2% to 0% between June 2006 and December 2008. Then, on March 15, 2017, the Fed announced its third interest rate increase since December 2015. The new benchmark rate is still historically low, but we could experience two or more increases this year. As a matter of fact, the most recent PCE deflator data, a key indication, a measure, went beyond the Fed's desired 2% benchmark for the first time since 2012. As a result, some analysts believe we may see more than two more interest rates increases before the year's over. Well, for now, anyone with credit card, home equity line of credit, or other liabilities that have an adjustable rate interest rate may potentially see an increase in their payments very soon. But remember, rising interest rates also indicate that the economy is growing stronger. Overall, 2017 has experienced a largely positive start, and we continue to see a variety of encouraging economic data. If you want more guidance on approaching your financial needs or balancing your assets and liabilities in the current environment, we're here to talk to you. Also, we wanted to make sure we introduce Jessica Golden, our new relationship coordinator. Make sure to give her a call and say hello. Well, that's it for this month's educational economic update. Once again, I am Vincent Virga, President of PFS Wealth Management Group, signing off for the month of April 2017. Please remember that nothing we talked about here is a recommendation. If you'd like to discuss your personal financial situation, give us a call at 888-331-2821. We'll be happy to talk to you. Once again, 888-331-2821. And make sure you say hi to Jessica. Talk to you soon and see you next month.